morning and welcome to NYSE TV Live. I'm Kristen Scholler here in studio at the Stock Exchange. Well, stocks are set to begin their first trading day of February after the major indexes notched new highs in January and ended the month with gains. In fact, the Dow Jones Industrial Average led the way last month, up 4.7%. Despite some choppiness, the S&P 500 rose too for an increase of 2.7%. In focus this week will be the latest monthly jobs report, earnings, including from the major tech companies like Amazon and Alphabet, as well as recently announced tariffs by President Trump of 25% on Mexico and Canada and 10% on goods from China. Let's take a look at what's on tap in today's show. Well, at the start of each month, Intercontinental Exchange, the parent company of the New York Stock Exchange, releases a new mortgage monitor. And ICE's Andy Walden will join me soon with those details. Plus, the Super Bowl is less than a week away, and we're breaking down what we can expect when it comes to big advertisements. And as earnings season picks up steam, Christine Short of Wall Street Horizon will tell us where we stand and what to expect from big tech results this week. Well, as we continue to follow the action in equities, we do the same for the mortgage market. In fact, today, Intercontinental Exchange released its latest mortgage monitor looking at the data across the industry. And joining me now with more is resident expert Andy Walden, Vice President of Research and Analysis at ICE. Andy, always great to see you, especially on a Monday morning. And what are the top takeaways from February's mortgage monitor?
Yeah, a lot of interesting insights coming through the door here at the early stages of February. The first is that mortgage delinquencies are gradually beginning to trend higher, especially on the lower end of the credit and lower end of the income spectrum. And that certainly will be an increasing focal point for the market as we move into 2025. A lot of data coming in around the recent wildfires in Los Angeles about insurability and insurance, along with some of the financial pressures that are facing homeowners in those areas. And so we can discuss those here in a little bit as well. And then the latest on the housing market. So supply, demand, and price dynamics as we enter the 2025 home buying season.
Well, of course, our hearts go out to those impacted by the wildfires last month in Southern California. As you alluded to there, what does the data show about that area?
Yeah, absolutely. And the human aspect comes first, obviously. And so as you mentioned, our hearts go out there to everybody impacted by those fires. When we start to overlay some of the geospatial data from those fires on top of public records data and mortgage data and even municipal bond data, we see a few trends that are starting to jump out here. First of all, if we get a lay of the land in terms of the magnitude of those fires, over 17,000 single-family homes and condo units in those areas, many of which were damaged or destroyed. And so this is one of the largest wildfires, not only in the state of California, but nationwide in recent memory. When you start to look at the impact on finances among existing mortgage holders in those areas, we're already seeing nearly 5% of folks that are struggling to make that January mortgage payment. And keep in mind, those fires broke out later in the month of January, and so we could see more significant impacts as we get into February and March. When we go into the insurance side of that issue, you see that the state's FAIR Plan was the second largest insurer among those affected homes. They covered about 1 in 8 homes in affected areas. I think that could have a pivotal impact for the way that the insurance is dealt with, not only in that area, but the state of California. It could reverberate outside of that state as well in terms of pricing. And so I think that's something that the market should be aware of. And then when we look at the muni market, you had nearly $60 billion of munis at least partially exposed to those areas. And for the first time, our ICE climate team has been kind of hinting at this in the past. For the first time, you're seeing some almost immediate repricing of some of those munis that were exposed, especially in the LA City Water and LA City Power municipal bonds. And so again, something that's going to be a bigger and bigger topic of conversation as these natural disasters become more frequent and more damaging.
I do want to talk about pricing in a moment, Andy, but if we could switch gears here, there is maybe a light at the end of the tunnel, at least at the end of this week, and that's because the Super Bowl is this weekend. Hopefully it will be a fun event. I'm sure it will be. And it's my understanding, in fact, that housing data could be a predictor. So what fun stats can you share ahead of the big game?
Yeah, certainly a little bit more lighthearted research there around the Super Bowl. And we were trying to dissect, as everybody is, to try to get a little bit of an edge on what's happening in the game this weekend. What we found when exploring the ICE home price index is the team that has had the hottest housing market entering each of the last 6 Super Bowls has won the contest. So that would give the edge for those folks that believe in that type of thing. I would give the edge to the Philadelphia Eagles this weekend. They've been running at about a 6.5% home price growth versus Kansas City's 4.8% growth. For Chiefs fans that are looking for some light there, if you go back to 2010 to 2017, before the last 6 years, becomes a little bit more murky in terms of housing market predictability. So, maybe a little bit of light there for Chiefs fans, but the ICE Home Price Index says maybe Philly has an edge this weekend.
Philly has an edge, and to that end, Andy, I do want to hear more about which markets are trending in which direction when it comes to pricing and other metrics.
Yeah, when you look at it from a geographic perspective, we've been seeing this Midwest, Northeast, specifically Northeast, hot, South, Southeast, cooler trend really for the better part of 2024. And it really has to do with what's going on from an inventory perspective. The Midwest and Northeast are still dealing with very deep inventory deficits just in terms of the number of homes available for sale at any given point in time, and they've been slower to recover throughout the last calendar year. And so, you're seeing firmer prices in the Midwest, Northeastern regions of the country. 18 of the 20 fastest growing markets this year from a price perspective were in those areas of the country. I think it's reasonable to expect those areas to be firmer as we make our way through the early stages of 2025. When you look at the markets that have seen inventory levels return a little bit more quickly and are now back to or above normal levels, you look to the South and Southeast, and you're seeing softer prices in those areas of the country. Unusually, the West is a little bit of a middle ground right now, where you're seeing, not too hot, not too cool prices in that portion of the country. And again, I think it's reasonable to expect those geographic breakdowns to continue as we make our way through the early stages of this year.
So, of course, on the horizon is the spring buying season. How is that expected to trend, the housing market, into that pivotal time?
Yeah, absolutely. And let's go back to 2024, and then we'll carry that forward to 2025. If you look at what happened last year, softest home price growth that we've seen in any calendar year since 2011. And so you are seeing a little bit softer price dynamic out there. Now, demand is still relatively good. It's about equivalent to where it was this same time last year, despite interest rates being a little bit softer. But the fact that you're seeing more inventory out there in 95% of markets than we were at this time last year means that homeowners, as we enter this spring season, will have a little bit more inventory to shop amongst, and will likely be looking at a little bit softer price environment than what we were seeing at this point last year.
And so how do you expect that to change the dynamics, Andy, in terms of the overall health of housing?
Yeah, I think it's a slow move in a positive direction, right? We still, as we know, we have affordability challenges out there in the market, but demand is holding relatively stable, right? Interest rates, if you look at 30-year rate futures, they're predicted to modestly come down as we make our way through the middle stages of 2025. That should improve demand out there a little bit, running up against more supply than we've had over the last few years out there in the market, which means a little bit softer price dynamic, which is what we need for affordability to improve. And so I think, slowly but surely the market moving in a positive direction here. And when you look at the housing market from a Fed perspective, I think it's moving in the way that the Fed wants it to, right? In a positive direction overall, but a slower rate of growth, most certainly, than what we've seen over the last 4 to 5 years.
Andy Walden, Vice President of Research and Analysis at Intercontinental Exchange. Andy, thank you as always.
Thanks for having me, Kristen.
All right, well, stay with us because up next on NYSE TV Live, the price of a 30-second Super Bowl ad is hitting a new level. And our next guest will tell us if it is money well spent. Stay with us.
Today we're taking you behind the scenes of Summit One Vanderbilt. This extraordinary destination offers stunning views and immersive experiences, providing a truly unique perspective on a city that never sleeps. That was the most incredible elevator ride I've ever experienced.
Yes.
How long did it take us to get up here?
35 seconds to go from the ground floor all the way up to the 91st floor. It's pretty incredible.
Pretty incredible, and the experience starts the moment you step into the elevator.
Absolutely. We take you from one room and one experience to another to help transition you. And right now in the Hall of Light, we're about ready to go into Transcendence. You ready to go in?
I'm ready.
Perfect.
Let's go.
Let's do this.
Wow, this room is amazing.
Wow is right. We are in Transcendence. We are on the 91st floor here in One Vanderbilt, and this room truly is spectacular. It's probably one of the most Instagram locations in the entire world. We are in probably the most famous and most sought after room in all of Summit. We're in Affinity. And what this really speaks to is Kenzo's vision of play. By no means is One Vanderbilt or Summit an area of being passive. We encourage you, we want you to be part of the installation. Here, you become actually involved within the installation of the space. Obviously, from the balloons themselves, people that come into this space are able to make it their own. They're able to come through and actually see the world in a much different component. They really are. It's a unique view that you're not going to get anywhere else in the world. I would even encourage you, quite frankly, to help come through with me. So we have people who come here who automatically know where they want to stand, what they want to wear, and quite frankly, the type of picture they want to take, because they know it's going to be shared all across the world. And that's the most amazing thing here. People are evangelizing the product for us. They're evangelizing the Summit brand. And in doing so,
welcome back to NYSE TV Live, everyone. I'm Kristen Scholler here in studio at the Stock Exchange. Well, according to multiple reports, the price of one 30-second ad during Super Bowl 59 has soared to a historic level. The reports claim that at least 10 commercials airing during the big game were sold for a whopping $8 million. Fox CEO Lachlan Murdoch saying this past November, quote, "Were sold out for the Super Bowl at record, what we believe is a record pricing," end quote. Well, to learn more about what is in store for the biggest advertising event of the year, joining me now with more is Nick Primola, Group Executive Vice President for the Association of National Advertisers. Nick, welcome.
Welcome, thank you. Thanks for having me.
Great to have you. Big game, less than a week away at this point.
Yeah.
Is the money worth it? $8 million on average per 30-second spot.
I think we could say unequivocally, because of what you just said, it is more than worth it. It's not going to sell out. That inventory is not going to sell out well before the Super Bowl if it wasn't. The advertisers that we have are so sophisticated and so smart. They're able to track the impact of what they're doing and what they're spending. And so safe to say it is worth it and more.
What are those tools that advertisers can use to measure the investment that comes with one of these Super Bowl spots?
Well, it's not just the spot itself during the game. It's what they have during previously leading up to the game and after. So it's really exciting to kind of see the whole theme come together. And what you'll see, what you won't see is the sophisticated tools that they have for tracking spend, like AI, for example. You're going to see a lot of AI, hear a lot of AI, but they're using a lot of AI to track what they're doing, who's watching, where they're watching, and how they're getting their information from, and ultimately what they're buying.
Mm-hmm. What do you think are going to be the top ad themes this year at the Super Bowl?
So a couple things, right? You've got, oddly, gaming is huge this year in the Super Bowl. You have a lot of, let's say, down to earth, sort of getting down to just everyday life and enjoying it, right? So you have that just sort of, everyone's relaxed, right? You have a lot of previous years, people trying too hard, people forcing new products like crypto bowl, metaverse, and that sort of thing. I think it's really just kind of getting down to basics and enjoying, what it's all about. Just nice entertainment.
Mm-hmm. So gaming will be popular. Anything that you think advertisers in this environment will stick away from?
Well, certainly stick away from anything that is divisive, because what you're doing here is you've got the biggest platform where you have the largest audience that you're going to ever get. And this audience is unlike any other audience because they're tuned in for the ads. Many of them are going to be talking about the ads well after the Super Bowl, many of them more than the game itself. And so that's unprecedented. And so what you want to do is be as appealing to as many people as possible. You're going to have multi-generational, audiences on the same couch, grandparents, parents, and kids all watching the same thing. So you have to appeal to that broad audience as possible. So you really want to stay away from anything that's a little bit too quirky, controversy. You're not going to see a lot of fly-by-night sort of companies. You're going to see a lot of smarts and intelligence that went into this and making it the biggest opportunity for growing the market, not just stealing share, but growing the markets.
When does the planning start for these 30-second spots, and when are the dollars actually committed?
Well, the dollars are committed in various ways throughout the year, but pretty much you're budgeting for 2026 right now, and in the next several months. So more or less a year ahead, you're planning, and it really comes down like anything. It's a marathon, but it does come down the final stretch in the final months. Some of them actually start to keep things really, really fresh, really just in the last month or so. But things like Doritos, where it is a long campaign, you require many submissions into the actual events. I think they have like 15 spots that are finalists for the events, and so that takes a little bit longer of a lead time.
Does it change the game, the matchup, in terms of what these advertisers can get, the bang for their buck, knowing that the Chiefs, it could be a three-peat Super Bowl?
Well, you've got that Chiefs factor, which I call the, in the Super Bowl, really is the three-ring circus of the Super Bowl itself, the halftime show, which is bringing in new audiences each year, as well as, I'm going to say it again, I know it might cringe, but the Taylor Swift effect, which was, last year was a big deal, but, that call it that in a category, you're bringing in way more female viewers who maybe wouldn't normally watch football or sports in that matter, and that's a great opportunity to grow market with important decision makers in the household.
Are there stats that you can share about that? We had seen Taylor Swift last night at the Grammys. She was in a sparkling red Chiefs-like wardrobe, Nick, okay?
Right, yeah.
So how do we know, what are the numbers you can share about that demo that's been brought in?
It's safe to say you can tell by the advertisers. I don't have these specific numbers of new, female audiences or not, but the advertisers that you're bringing in are attracting and moving towards that female audience, and so that's a big extension for the NFL. Because what does the NFL do then? It has flag football for women. It's extending its markets internationally, and so that's a big play for the NFL, which is really, really smart. And the more they can do to kind of extend that audience and extend the advertising base, they're really nailing it.
When it comes to ad dollars, is there anything that even pales in comparison to the Super Bowl?
No, I think you could look at various Olympic buys and investments and like the big, but not in a one moment sort of thing. And really for advertising, it is the Super Bowl of advertising. It's the Oscars of advertising. It's everything for advertisers because the attention is on you. You can get it really, really right and have a lot of company growth. Or, you've seen in the past some missteps, and getting it wrong has a lot of consequences as well. So there's a lot riding on this game.
Any new names you expect to hit the advertisements this Super Bowl?
You've got some new products, right? So you've got AI, coming at it. You've got FanDuel in a big way. I think Caesars as well. So again, some of the gaming, they're trying to grow their markets into the arena here. But you also have tried and true names, right? Budweiser. Look at what Hellmann's is doing, right? They're bringing back a storied brand and a classic story of How He Met Sally in a new, fresh way.
Nick Primola, Group Executive Vice President for the Association of National Advertisers. Nick, thank you.
Thank you so much, Christine.
All right, well, we've got plenty more to get to here on NYSE TV Live as we approach this morning's opening bell. Stay with us and we'll count you down to that market open.
You both are coming to the exchange today to share the major news announcement. Why don't you tell me a little bit more about it?
Yeah, so we just passed 200 million in annual recurring revenue, and I met you last time 15 months ago when we made the first announcement, and so we're super excited. We're growing 70% year over year, and it's just due to the amazing success that we're providing to our customers.
Abby, would you like to add to that?
Such a whirlwind being at Cribble. I'm so proud of us, and to take 4 years to get to 100 million and then start, double it in 14 months is pretty exciting space to be in.
That's hugely significant, especially the time period that it all occurred. So what would you attribute this momentum to, and how do you think they're going to continue to leverage this fundraise?
First of all, back to the customers, it's about the value that we provide to them. It's an underserved segment. It is people who are running the systems that run the business, and the top growing companies in the public markets are growing at 30%. We're growing at 70%, and it is all back on on the value that we provide to customers.
Abby, from your vantage point, how are you going to continue this momentum with growing those client relationships as well as enhancing your bottom line?
Well, our number one value at Cribble is to be customers first always, and we're constantly focused on how can we do the next thing that solves the problem that nobody else is solving for them. And so one of the things that I'm really excited about is that when we talk about our solutions and our ability to provide a data engine specific to IT and security, one of the gaps that we had was that we were able to provide analysis, but not in real time. And we have an exciting product announcement coming up that I'm going to let Clint talk about a little bit.
You beat me to the punch. I'm so excited to hear about the new product. Tell me about it, Clint.
This is an add-on to our Lake product called Lake House. As Abby mentioned, the biggest gap was I need to be able to ask and answer questions of data that's arriving right now, and I need that to be fast. I need my dashboards to go quickly. I need my alerts to fire really, really quickly. And so with our new offering in Lake House, we can start.
Welcome back to NYSE TV Live, everyone. I'm Kristen Scholler here in studio. Well, NYSE TV covers events both inside this iconic institution, but also headlines being made across the country. And at last month's ICR conference in Orlando, our Judy Shaw spoke with Fogo de Chão CEO Barry McGowan about his brand and how it's grown over the past 45 years, its plans for more growth around the world, and the pledge with No Kid Hungry to help end summer hunger. Let's take a look.
I get up every day and find joy in feeding people. "45 years of doing what we've always done is incredible. So we're rooted in authenticity, but really just focusing on the century-old culinary art form of churrasco. So it's an incredible model, allows us to innovate, stay relevant to trends, and give the consumer all they want. Remember, we don't have a menu, so the culinary art form allows us to curate in the moment and allow our guests to discover the whole time. So it's incredibly relevant to today's consumer. Our millennial, Gen Z, Gen X consumer wants immediacy. They want to be able to customize and really experience food in the moment. And this is what Fogo de Chão continues to grow and leverage as we continue to look to build restaurants around the world.
Now, in 2024, you achieved quite a milestone. You opened your 100th location globally. So tell me, what drove this growth?
Our culinary art form, our style of dining, and the value proposition we offer has just been well received by the American public. Again, a very diverse demographic across America. So it's been pretty exciting. So to get there to the 100th opening was a huge milestone, but we're really excited about, we're talking about internally, is by the middle of next year, we'll have 10,000 team members in our Fogo family. That's what makes us really proud that we have such a big team now, that we're growing talent from within, and let's say this, our human capital is growing as we open new sites, which is fantastic.
And Barry, tell me, how do you keep up with the menu innovations while maintaining your brand heritage?
It's seasonal in nature. It's always relevant in terms of innovation, and we have a great deal of flexibility because we're not encumbered with a menu to make a plate. We kind of plate and curate in the moment based off seasonality to give you all the value, all the experience, and keep our price really affordable so that you can enjoy the very best the market has to offer. So it's a great way to dine, wonderful way to dine. Barry,
tell me a little bit more about your unique guest demographic.
It's 87% millennial, Gen Z, Gen X, 42% female, and ethnic in nature. And we have a family component of 26%. So if you think about generational, how people like to dine, it's only going to keep going that way. And our model is already developed. We've just been doing that for 45 years, and we're leaning into that because regardless of your diet tribe, we can customize to you and give you the experience you desire, no matter who's at your table. So it makes it a lot of fun. And I think it really does drive the demographic that we have because they don't want to be told no. Again, they want it now. And the idea of price value matters. It always has. And we continue to, invest in that.
And as you look ahead, what are Fogo de Chão's plans for future expansion, both domestically and internationally?
We've already proven out the market coast to coast. Now we're building restaurants around these markets because our biggest obstacle to trial and frequency is convenience. So like every brand, we're just now, after 27 years in America, 45 years as a brand, at that point where now we're getting the benefit of awareness, trial, and frequency. And we've upgraded, by the way, to Gale Agency in New York to help us unlock the social channels that we've never really been able to do. We're launching our first loyalty program. All that will help support our unit development growth to basically drive awareness and trial. So really, really excited about it's going to happen in 25 and beyond.
And finally, Barry, you've made a pledge with No Kid Hungry to end summer hunger. As a matter of fact, you're participating in a panel here at ICR with the CEO of Macy's to encourage other CEOs to join you. Tell me about this initiative.
The most vulnerable in every community matter. Everybody talks about economics, the economy growth. You need healthy ecosystems, healthy economies, and it starts with the child. So look, it matters to us. Our industry, I get up every day and find joy in feeding people. There's nothing more important than feeding those who are most vulnerable. So ending childhood hunger in America is solvable. And what I really appreciate is those CEOs that have stepped up, we all agreed that we could do our part, regardless of what industry you're in. Let's come alongside our consumers, our business, and let's make a choice and help Billy Shore and the team at Share Our Strength end childhood hunger. And really exciting to see the progress we have coming on today.
It's an amazing initiative. Well, it's been wonderful to talk with you, Barry. Thank you so much for joining me on Floor Talk today.
My pleasure. Great to see you, Judy. Great Portuguese, too, by the way. Good job.
All right, thanks to Judy Shaw for that interview. Well, stay with us because up next we'll learn more about today's bell ringer, which is here as Black History Month kicks off. We will have more on the other side.
In Unanchored is the advent of geolocation data on cell phones. And this was largely unavailable until, call it 2018, 2019. That data is so robust that you no longer have to only rely on tenant sales that are reported by the tenant. Now you can rely on customer traffic from cell phone data, which is incredibly robust, and it allows landlords to have information that we didn't have before. That, to me, is what really crossed the Rubicon between private investors making a local bet on convenience properties to now institutions, and us being the only public institution, really, being able to make a thesis that has math behind it that I think is convincing and durable. How frequently do you run an errand to go out at lunch and go to Chipotle? Do you go to the ATM at Wells Fargo? Does somebody in your family get your nails done? Do you go to the barber shop? These are running errands. These are not going shopping. For you to run errands, convenience is key. You want speed, access, and you want it to be in a timely manner. What we've really proven, and this is really through the data analytics, is that going shopping and running errands are two distinct, different property types. And being different property types, they deserve to have their own asset class for effectively running errands. And I'll give you some statistics. 2/3 of the customers that come onto our properties at Curbline are on our asset less than 7 minutes. That's not a going shopping experience. That's not lingering longer. We're not placemaking. We're not making a place where you linger forever or you multiple shop. We want a place that is right up on the road, easy to your house, and you're in and out. That is the biggest asset management question. Do you renew a tenant or do you replace the tenant? And so this is not an occupancy business where you buy vacant buildings and you lease them up. You're buying fully leased buildings, and the question is always every single year, are you going to renew this tenant or are you going to kick them out and replace them? And that.
Welcome back to NYSE TV Live, everyone. I'm Kristen Scholler here in studio. Well, in just a moment, NYSE listed M&T Bank will ring the opening bell to celebrate the start of Black History Month. Company chair and CEO René Jones will do the honors, and it is worth noting that Jones previously rang the bell in 2023 for Black History Month too. Well, the firm, which provides banking products and services to 12 U.S. states, including Washington, D.C., says it is committed to improving the lives of their customers and communities that they touch. Black History Month was first officially recognized in the U.S. in 1976 by former U.S. President Gerald Ford. Now, in doing so, Ford called upon the public to, quote, seize the opportunity to honor the too often neglected accomplishments of Black Americans in every area of endeavor throughout our history, end quote. We will await that very important opening bell, of course, as we get ready to celebrate the first trading day of February. There is a live look at the opening bell podium, and we'll be taking that momentarily, of course, with much to talk about in the markets. Let's take a listen. All right, we are officially off to the races. That is the opening bell, the first opening bell, in fact, of February 2025. And joining me now to talk more about the markets is Sean O'Hara. He's a president of Pacer ETFs. Sean, thanks so much for joining. A lot to digest this morning. Let's start with tariffs, of course, because that is moving markets amid a busy week of other themes like earnings and jobs, too. What's your reaction as we begin this Monday morning?
Well, I mean, I don't think it was a surprise that the president was going to do what he did. However, I don't think the market's necessarily reacting very favorably to it. It perhaps is a little bit too early to, sort of see what the end effect is going to be. I think anybody who has followed him over the course of his past, in the time he was president, knows that this is sort of how he operates. And he did the same thing last time and everything worked out fine. I think, we'll have to wait and see here how long this takes and whether or not we can actually get to some common ground that's a little bit more common sense or agreeable to everybody. So I think that's a big part of the story with regard to what's driving the markets down today. I also think that, you need to keep an eye on the fact that the markets have been somewhat stretched as far as valuations. And so this may be just be an opportunity that, it's coincidental to the tariff announcement, where people are just sort of taking a little bit of profits or rebalancing portfolios, try to reduce their risk a little bit.
I do want to talk about earnings, Sean, because that, of course, is a key fundamental that does move the market over time. And we've seen a good amount of companies report, the vast majority of them exceeding earnings expectations, not as many exceeding revenue estimates. What is your takeaway from this reporting season so far?
I think it's been sort of in line. I think we've expected to see earnings grow somewhere from around 10 to 12%. It's been sort of a mixed bag, if you will. There have been some winners and some losers. I think that the story going forward is, can we sustain these numbers with regard to earnings growth? And I think some of the things that are on the agenda for this administration, if they can get them done quickly, will be a good sign for the markets going forward. If we can get, some reduced regulation, for example, or if we can get corporate tax cuts. All those things are good for the bottom line of companies. And so that may help sort of the E part of the PE equation that we talk about so often catch up. The last couple of years, we've seen a pretty significant expansion in multiples. And so, those things don't tend to last forever. They only last until people believe that the earnings growth is not going to be there. And I think we're still a little bit early as far as whether or not we can come to any real solid judgment there.
Well, the jobs report is on tap, released the first Friday of every month. Of course, the jobs report that we'll get on Friday does cover the month of January. How does the jobs market look to you, Sean?
I still think there's more job openings than there are people. So in that regard, I think it looks pretty good. I think, the unemployment number is relatively low. I think, the Fed watches that in addition to inflation. And so I think they'll keep a very, very tight eye on the jobs market. I think we'll come in sort of in line with where everybody's expectations are. I don't expect to see any big collapse, if you will, in jobs or any real huge surprise to the upside.
Now, when it comes to capital flows, of course, with Pacer ETFs, you would have a good sense as to how the dynamics are changing in real time, Sean. What can you tell us about that?
Well, I think the big story is it's all U.S., and particularly large cap U.S. I think that's been the dominant flow trend for a while, and it's continued into this year. We're certainly seeing that on our side of the equation, whether it's into large cap value or large cap growth. We do take a little bit different, have a different take on both of those things and how to construct portfolios using free cash flow on the value side, free cash flow yield, and on the growth side, free cash flow margin. And we've had some nice flows. We've started to see a little bit of a leaning towards some of the risk mitigation strategies that we have. I think, as people start to see this market get a little bit stretched, or we've gone, up to plus 22 years in a row. I think folks are looking at ways to perhaps, lock in or protect some of the profits that they made. So there's been a little bit of a change there as well.
I do want to talk more about diversification because we've heard people say that it might be a stock picker's market. What do you see when it comes to diversification and active versus passive investing, Sean?
Well, I'll give you a great example, Kristen. We have a large cap growth fund, COWG. It uses free cash flow margin as its screen. And it has competed very well with the NASDAQ 100 and the Russell 1000 growth. Actually, we're producing better returns. But when you look at it, it only has about 17% overlap to those big broad indexes, and it only has 4% of its weight in the Mag 7 names. And so I think that's the diversification story that needs to be told, is that, we are in a position now where we're probably as less diversified in these broad indexes than we've been in quite some time. And that's been great. Everybody's been celebrating it on the upside, but however, if things reverse themselves, it could be just as disastrous, if you will, on the downside. And so one of the things we're focused on is trying to help financial advisors diversify their growth holdings by using a slightly different approach and not having that over concentration and that big overlap to everybody else's growth fund.
Mm-hmm. When it comes to the Trump administration, Sean, those tariffs were announced on Saturday, over the weekend in the markets, responding this morning based on the data inputs. What is the next thing that you feel like the investing community may hear from the White House?
Well, they're obviously pushing on corporate taxes, which is good for stocks. I think the next thing we'll probably hear is that this sort of a mini trade war is going to get itself resolved here fairly quickly. I don't think that Canada and Mexico can really put up a huge fight. I think they can posture a little bit, which they should, right? But at the end of the day, I think we'll wind up with a resolution here that that all three countries can deal with. And then I'd be looking for some of the things that would help profitability, like regulatory change. Try to get some of the red tape and the bureaucracy out of the way of some of these big companies and all companies for that matter going forward. I think that's also going to be a big driver for future growth.
Sean O'Hara, president of Pacer ETFs. Sean, thank you so much.
Thank you so much. Good to be with you.
All right, well, stay with us because up next, earnings season rolls on with a pair of Magnificent Seven companies set to report their quarterly results. We'll have more on the other side.
Welcome to Floor Talk. It's great to have you on the show.
Thank you so much for having me.
So, Josie, congratulations are in order. You are part of the Buffalo Bills ownership group. Now, it was a great weekend for you this past weekend.
Amazing weekend, yes.
Had the family with you to celebrate a win. So tell me, what drew you to this opportunity and how does it fit with your goals?
Yeah, so the process started for me actually back in 2018. I originally had set out to put a group together to purchase the Real Salt Lake soccer team. And it was through that experience where I was approached by a representative from the NFL asking if this is something that I'd be interested in, as the league was looking to be more diverse in the type of LPs they accepted. So right away, I fell in love with the opportunity, and it went quickly, but I'm happy it did. And it's an honor to be a part of such a world-class organization.
Now, you're also involved in ventures like TGL, SailGP, and Footy Market. So tell me, how do you choose what to pursue, and what's your vision as an entrepreneur?
I tried to stick to things that I'm passionate about. And Footy Market is a gear exchange where you can buy and sell used gear online. And that one was close to my heart, being that I spent, my whole life dedicated to soccer. And I'm a big fan of emerging sports. TGL is obviously, golf has been around a long time, but TGL is like a new variation of the game, right? Trying to give viewers a different experience. And then SailGP is more of the same. It's something that we've known people are passionate about in terms of sailing, but now trying to package it all as a league and an emerging sport is something different. So super excited at all of my ventures and things that I work on. And, for me, it's another way of being on a team. It replaces being on, a field. So I've been having a ton of fun, and, it's just the start.
And Josie, as you grow your business portfolio, how are you building a legacy that's beyond?
Good morning and welcome back to NYSE TV Live. I'm Kristen Scholler here in studio. Well, as of the end of January, 36% of the S&P 500 has reported earnings so far, with 77% exceeding earnings expectations. Joining me now for a deeper dive is Christine Short. She's head of research at Wall Street Horizon. Christine, welcome.
Thank you so much for having me.
A lot to talk about, as always. That's exactly right. So let's start off with what is on tap this week. What can you tell us?
Yeah, big first peak week of the season. Actually, it always comes a little later in Q1 just because of the holidays, and we're coming off of the New Year. And so from now to the end of February, we're going to see the biggest chunk of S&P 500 companies reporting. The two big ones this week, as you know, Alphabet and Amazon. We're kind of rounding out what some of the Mag 7 companies started last week, and we always kind of close it up with NVIDIA, which is not out until February 26th. But again, a lot to talk about with DeepSeek, emerging early last week, which actually didn't seem to impact many of those names as much as we thought, right? Investors saw it actually as a good thing, right? Cheaper generative AI is good for all. It brings down costs. Let's forget about what these companies have spent. Those are sunk costs at now, and let's look forward at, this is technology that can be used more cheaply, more efficiently. So I think you're going to see that in the Google commentary, the Amazon commentary this week. You'll want to hear an update on AI out of Google. Revenues expected to be up EPS 30% year over year, revenues 12%. A lot of that has to do with Google Cloud Computing, still very strong, but also you're going to want to hear about AI spending. And a few Wall Street analysts actually said that Google, Alphabet should benefit the most from this DeepSeek emergence because it will sort of raise the urgency on product development. Now everyone's like, we got to get out there, we have to match that, and we can do it.
Interesting. So, of course, these results, Christine, 2 of the 7 Mag 7, at least, following what were 4 reports from major tech companies last week: Meta, Microsoft, Apple, and Tesla. What were the takeaways there?
It was a pretty strong reporting season, I will say, with the exception of, I think Microsoft kind of got unfairly dinged a little bit. They did beat on the top and the bottom line, but once again this quarter, it's the softer revenue guidance that investors didn't like. But again, I think they're one of the names that's going to benefit from this DeepSeek emergence. Tesla's sort of a different story. They missed once again on the top and the bottom line. I think investors just really believe Elon Musk's ties to President Trump will help his industry, will help bring down, make policies a little easier and bring down any sort of regulation on EVs. Meta did great again last quarter they had a little bit of a cooler user growth number, and investors weren't so happy about that. But this quarter, they posted revenue growth of 21%. They kept their AI spending plan, which I think was positive, right? They said they're going to be spending about 60 to 65 billion this year, and that they believe Meta AI will reach 1 billion users in 2025. So investors really seem to like that. And then Apple, yes, iPhone sales have been down, weaker in China, but investors didn't really grab onto that as much as they did this. That was expected, that was sort of priced in, but revenues were up 4%, and they guided for low to mid-single-digit revenue growth for next quarter, and I think investors were pleased with that.
Now, I'm curious, Christine, I know you follow this so closely, what we hear from these executives on the earnings call.
Yes.
What are we finding that's top of mind for them?
Yeah, I think it's been a little more upbeat. The end of last year, we heard a lot of cautious commentary. The banks always kick it off, so they tend to sort of set the tone. And we actually heard from David Schwimmer at Goldman Sachs. They actually felt that CEOs were more upbeat. They said some of this was likely due to President Trump getting in as the U.S. president, but they felt like CEO confidence was higher. We track that through our late earnings report index, our proprietary metric that tracks companies that delay or advance earnings reports, which can be, academic research shows if you delay an earnings report, it comes with bad news on the call. And that's actually been below benchmark this season, which is positive. It means companies are less uncertain than they were the last several quarters. And so we are seeing a little bit of that. But now with what's happened over the weekend with tariffs, with more certainty and clarity, I think we'll see more commentary on that. Not that we haven't, but it wasn't as clear as it is now. They have been imposed. Before it was just if and when and if Trump gets in. And so there were plans being put together, but it was unclear if they would have to use them. And so I'm interested to see how those reporting from this point on are going to talk about those.
And I would suspect that we would hear from a lot of analysts wanting to know from companies across various sectors what this impact might be, because I think heading into this weekend, the expectation is it might be a negotiating tactic, not necessarily a literal imposition.
Yes, it's interesting how after the inauguration, there was almost this optimism because they weren't mentioned. There was this optimism, as you're saying, that they weren't actually going to happen. It was just, during the campaign messaging, and was it going to be a literal thing? And so I think that's why you're seeing markets react the way they are now, because they had this optimism around them possibly not happening. And then also, unlike the tariffs he imposed in his last term, this is not a phase-in. This is an immediate. There's no chance to sort of catch up and phase these in. It's happening right now. And so I think that's why you're seeing markets react the way they are today.
Quickly, Christine, before I have to let you go in just about 30 seconds, anything else we should know about this earnings season?
I think investors have been a lot more forgiving. The last few quarters we've said companies that are beating estimates are getting rewarded less than usual, and those that miss are really getting punished more than usual. We haven't seen that. We've actually seen, if one metric is off, investors are still, buying into that, and you'll see the stock pop. And so that is one thing that we've seen. And like I said, overall confidence seems to be a little bit higher. You're seeing companies beat by a higher percentage. So you mentioned at the top, 77% of companies have beat. They've beat by an average of 5%. I think that gives us enough leverage to get to those lofty estimates that analysts are expecting for the back half of the year.
Christine Short, head of research at Wall Street Horizon, always with a bevy of knowledge and stats. Christine, thank you as always.
Thank you for having me.
All right, well, stay with us because up next, Proppy is looking to serve as the epicenter between the housing market and cryptocurrency. The company's CEO will tell us more after the break.
Here at Money 2020 in Las Vegas, one of the big key topics of today's discussions and panels, obviously, with blockchain, cryptocurrency, and the regulation around that. Talk to me about what you're seeing right now in the sector.
I think that the sector is definitely maturing, at least globally, to the point of mass adoption. Of course, like we've been seeing this first and foremost in crypto adoption globally, that I think outside of the US, we are seeing a lot of countries, whether it's Europe, Latin America, and Asia, putting fairly good regulation in place. And on the back of that regulation, we are seeing a lot of adoption. I think that the most interesting part right now is that we are seeing a lot of adoption of stable coins for payments, which is very relevant for this conference, of course. But on Fireblocks, now more than 50% of the volume that we are processing, which is about this year, we're going to process $2.5 trillion worth of assets that are going to move through the platform. More than 50%, so 1.25 trillion, is actually stable coins, which is used for international cross-border payments.
Can you tell me more about what your expansion plans are from your vantage point, especially when it comes to DeFi?
DeFi has been at the forefront of what we were doing at Fireblocks. We have several hundreds of clients that are interacting with DeFi through the platform because it gives them better liquidity, better opportunities. And what we are been doubling down on is two main things in DeFi. The first one is to provide secure access and to enhance the security around DeFi. So as most people that are somehow familiar with the space, a lot of the hacks and a lot of the issues that we were seeing in crypto are related to DeFi. So creating the perimeter around the security and compliance that's such that it's...
Welcome back to NYSE TV Live, everyone. I'm Kristen Scholler. Well, we've been talking about real estate throughout the show, including Intercontinental Exchange's latest mortgage monitor. For a look at how the industry is evolving and moving on-chain, I want to welcome Natalia Karyaneva, Proppy CEO. Natalia, welcome.
Thank you. Hello. Thank you so much for having me.
Yeah, it's so great to have you on the show this morning. Talk to me more about how your firm is trying to advance real estate through on-chain.
Absolutely. So Proppy has been around for 7 years, and we're a licensed title and escrow company that is utilizing smart contracts and AI to automate the real estate transaction. And the mission is huge. We want to move property rights on chain and entirely to rebuild the infrastructure for real estate transactions, the mortgage system, and everything that we have experienced so far, because Web3 is all about moving ownership and moving assets and rights on chain, and real estate is acting as almost like a digital asset.
Mm-hmm. How does cryptocurrency factor into this process?
Bitcoin obviously is the standard as a store of value, And many Bitcoiners are looking to invest in real estate. In fact, during the last bull run, 12% of first home buyers use their crypto to fund their purchases, their down payments. So this weekend, we've done the first ever crypto collateral for an instant purchase of a property on chain. It happened in Hawaii. There were 3 bidders, and everything was guided by Ethereum smart contracts with minimum human involvement. So it was a fascinating, historic transaction for the mortgage industry and for the real estate one.
Talk to me more about what you see as the opportunity here and quantify it if you can.
The opportunity here, first of all, is to disrupt the $25 billion industry in America, which is the title insurance business, to rebuild it, as well as to allow the Bitcoin holders to enter real estate without the premature exiting of this asset and paying taxes prematurely. So those two assets, Bitcoin and real estate, while real estate being a $300 trillion asset class, they will become swappable. You'll be able to trade between Bitcoin and other coins and real estate smoothly, which means in America it would address the housing affordability because we'll have less fees, less middlemen, and new generation will be able to move between cities with increased mobility, but also having the exposure to the real estate and housing.
What has been the process, Natalia, of connecting blockchain technology to some of these more traditional systems?
That's a great question. In fact, we're building a settlement protocol by doing a lot of integrations with banks, online banking. So we don't do only crypto payments, but we serve a lot of our clients with wire transfers, but they're more secure because we're connecting them to smart contracts. And so it allows consumers to do the whole closing entirely online. And even as we are building it on chain, it allows them to save money, to save time, of course, but gradually all transactions, I believe, will move on chain, again, addressing the housing affordability and property rights globally. And we're very excited as Propi being building this technology in America with a new crypto regulation and the news that blockchain will be utilized more and more in the building of the infrastructure of the key American institutions in industries. We're very thrilled to be this American company with an American issued token operating in the United States and building all those integrations that are tying into the smart contract ecosystem.
Natalia, thank you so much for joining. Great to get your take. Natalia Karyaneva, Propi CEO.
Thank you so much.
Well, NYSE listed WNS, that's a business transformation and services company, announced its latest earnings in late January. Trinity Chavez spoke with the company's chief executive about what drove the company's recent growth. Let's take a look.
WNS Group recently posted strong earnings with a 15% spike in trading, driven by key investments in Gen AI and a robust client use case. To dive deeper into their performance and what's next for the company, we are joined now by WNS CEO Keshav Murugesh. Thanks for being with us today.
Pleasure, Trinity. Thank you.
So WNS reported steady revenue growth and an improvement in operating margin for Q3, 2024. So talk to me about the key factors that contributed to this operational efficiency, and how do you plan to sustain or further enhance margins in the coming quarters?
Well, first of all credit to my wonderful team across the world. They have focused completely on just one thing, and that's the client. So if you look at the overall financial performance of the company, first and foremost, we grew 3.2% constant currency sequentially this quarter, which is outstanding. Our operating margin came in at about 19.2% against 18.6% last quarter. We generated significant cash once again. We are on target to spend about $60 million in terms of CapEx, across the whole year. And more importantly, we've got almost 7 new clients that have been signed up during this quarter. So all of it augurs extremely well for the future. And in terms of just the future, our guidance continues to remain very, very strong. And the implied guidance that we have issued once again recognizes the fact that we should see sequential growth in Q4 as well. And we are quite confident about our prospects for 2026. In fact, I've signaled high single digit to potentially low double digit growth for the next year based on continuing this momentum and performance.
And WNS has really positioned itself as a trusted partner through its end-to-end domain expertise. Can you give some real-life examples on how this deep understanding of client industries has directly influenced revenue growth or helped clients achieve transformative outcomes?
First and foremost, we signed up on this mantra a few years ago that domain specialism is the key reason why clients would want to work with us. The reality is, you can go to the market and look for a provider that can help you just reduce cost and become a little more efficient. But it's difficult to find a partner who understands not just your business domains very well, but more importantly, is constantly investing in creating sub-vertical knowledge, as a result of which they are working with not just yourself, but many other players in your segment are constantly learning and therefore coming to the table with conversations and innovative new ideas that are new for a client. And this, I would say, is the most important kind of differentiation of the company. And backing all of this is a very strong investment in technology and disruptive technologies. So, for example, Gen AI is an area that we have been investing in, constantly creating a number of POCs, and all of this has resulted in a very, very strong momentum for us. And finally, I must say, looking at expanding across new service offerings, new geographies has worked very well for us. As I mentioned earlier, 7 new clients signed up, without counting the number of clients that we are probably signing up on new disruptive technologies. If I added that, it would be much more. And we have expanded our relationships with 52 of our existing clients as well. So we're seeing broad-based demand on digital-led businesses, transformation-led businesses, as well as cost reduction businesses, which is core to our clients.
All right. Well, thanks to Trinity Chavez, of course, for that interview. And that's going to do it for today's coverage, the first trading day of February 2025. We'll have more tomorrow, same time, 9 a.m. Eastern, right here on NYSE TV Live. Thanks for watching. I'm Kristen Scholler.
This tweet comes from Ryan Dietrich, who is a technician. It says via Twitter, for some context, on February 5th, 2018, the Dow fell 4.6%.
Being innovators in the market. Thank you for all you do every day to show the world what best in class truly means.
We are incredibly proud to join the ranks of other highly successful companies who partnered with this legendary institution.
What a time to be here. I am so proud of what we're doing. This is a huge milestone for our business. There's a lot of people responsible for getting to where we are today.
We have a role to play in bridging the gaps that exist today between us. Not many people get to do something big in this world, and we get to do something truly special.
This is such a wonderful place to both look back and look forward. I'm so optimistic about what lies ahead. It has been a privilege to be with you.